Hello guys, welcome to Investment Research. Today we're putting two absolute giants head to head, Pfizer and AT&T. Now on the surface, they both look incredibly cheap, but my deep dive analysis shows that one is a far, far superior investment. By the end of this explainer, you'll know exactly which one I think is the clear winner and why. Let's dive in. This right here, this quote is exactly what I look for as an analyst. It's these moments where the market gets totally fixated on some short-term noise and just completely misses the bigger picture. And that's the story for both Pfizer and AT&T. The market is punishing them right now, and that, for us, could be a massive opportunity. All right, so here's the deal. Both of these companies are absolute titans, true cash flow machines, and they're both paying out some really attractive dividends. But, and this is the kicker, they are trading way below what they're historically worth. Our job today is to figure out why, and to see if that discount is a trap or a golden ticket. Okay, let's get right to it. Just a quick look at the price-to-earnings ratio tells you a lot. Pfizer's trading at just under 13 times earnings, which is a massive 34% discount to its normal valuation. But then you look over at AT&T, and whoa, it's even cheaper at just 8 times earnings. Now, that brings up the million-dollar question. Is cheaper always better? Let's look under the hood. First up, let's talk Pfizer, ticker PFE. And look, what's happening here is pretty remarkable. We're talking about a world-class blue-chip pharmaceutical company that's dealing with what I believe are temporary problems, and that has put this amazing stock squarely on the discount rack. And boom, this one number basically tells the whole story, a 7% dividend yield. Let me tell you, when I see a yield that high from a company of Pfizer's quality, all my alarms go off, in a good way. That's not just a number. It's a huge flashing sign that this stock could be seriously mispriced by the market. And here's what the headlines are totally missing. Everybody is obsessed with the drop in COVID revenue. But while they're looking over there, look at this. Pfizer didn't just beat earnings estimates, they absolutely crushed them by 38%. That tells me the core engine of this business is incredibly powerful. And that core engine is just firing on all cylinders. I mean, sales of their blood thinner, Eliquis, are just soaring. They're getting lean by cutting billions in costs. And then there's the big one, the Metsera acquisition. This gives them a major foothold in the obesity drug market, which is poised to be an absolute blockbuster. That's a huge runway for growth. Now, let's switch gears to AT&T, ticker T. This is your classic telecom titan, right? They own the essential pipes of our digital world, they have a massive customer base, and yet the stock is trading at one of its lowest valuations in years. It's just wild. And just like Pfizer, AT&T has a compelling income story. You're getting paid a solid 4.5% dividend just to wait for the stock to hopefully get re-rated by the market. I mean, that's not bad at all. That yield is actually a bit lower than its history, which suggests the stock itself might be undervalued. So what's the bull case? Well, they're adding more high-value phone customers than anyone expected, which is great. They're also pouring money into building out their fiber network, and that's a high-margin business for the future. And most importantly, the dividend looks safe. The free cash flow is there to cover it. But, and you knew there was a but, we have to talk about the elephant in the room. $139 billion in debt. That is a mountain. To me, this is the number one risk, the Achilles heel for this company. In a world with high interest rates, that debt is a very heavy anchor. So now, it's showdown time. Let's put them side by side. This is where we need to go beyond the simple stuff and really dig in to see which of these companies offers the better shot at making us money, with less risk. And when you lay it all out like this, the story becomes crystal clear. Yeah, okay, AT&T wins on that simple valuation metric. It's cheaper. But look at what else matters. Pfizer pays you a much higher dividend. Pfizer has a perfect dividend history, while AT&T recently cut theirs. Pfizer has way better growth prospects. And maybe most importantly, Pfizer's balance sheet is just so much stronger and safer. I mean, just look at that gap. Let's just visualize that for a second. That is a massive difference in the cold, hard cash you get paid every quarter just for owning the stock. For anyone investing for income, this chart makes a pretty powerful argument all by itself. All right, we've broken them down, we've seen their strengths, we've seen their weaknesses, so now it's time for the final call. Which one is the better investment and what's the full thesis behind that decision? So, after all the analysis, after crunching the numbers and looking at the big picture, which one of these dividend giants comes out on top? For me, the verdict is clear. Pfizer is the superior investment right now.
It just offers a much better combination of value, income, and real growth potential. The market is absolutely missing the forest for the trees here, focusing on that short-term COVID story and completely ignoring the strong core business underneath.
So here it is, my complete thesis. I'm rating Pfizer a buy with a 12-month price target of $30. When you add that juicy 7% dividend on top of the potential stock gains, you're looking at a possible total return of around 30%. The big drivers here are going to be that Metsera deal paying off and the continued strength of their other drugs. Now for AT&T, I'm a lot more cautious. I'm rating it a hold with a price target of $28. So, still a decent potential return of about 17.5%. It's not a bad investment, but that massive debt load and slower growth just make it less exciting than Pfizer. If I'm putting new money to work today, Pfizer is the better bet. So how could you actually put this into action? Well, it all depends on your own risk tolerance. If you're an aggressive income investor, you might lean heavily into Pfizer, something like a 70-30 split. If you're more balanced, maybe 60-40 is the right mix. And if you're more conservative, you could go 50-50 to get that diversification across two different industries. Of course, no investment is risk-free. For Pfizer, we have to watch that Metsera deal like a hawk. If their new drugs don't pan out, that's a problem. You've also got to keep an eye on patents expiring on their current big sellers, and you always have the risk of regulators wanting to control drug prices. And for AT&T, the risks are pretty clear. Number one is that debt. It's just a huge overhang. Plus, they're in a constant knife fight with competitors like T-Mobile. And if the economy really slows down, that could put pressure on their cash flow and maybe, just maybe, that dividend. So I'll leave you with this question, bringing us right back to where we started. Are you letting the short-term headlines and all the noise make you miss out on the long-term value in your own investments? It's a critical question to ask if you want to find the big winners. As always, this is just my analysis, so make sure to do your own research. Thanks for watching, and I'll see you in the next analysis.